So we have our little tables for our panel discussion, and I introduce you now to our guests. First, I would like to call up Professor Francesco Franzoni. He is from the Università della Svizzera Italiana. Oh, mind your step. Okay. Professor Franzoni is from the Università della Svizzera Italiana and the Swiss Finance Institute. Yeah, okay. And then we have Pius Fritschi, Managing Partner and member of the Executive Management at LGT Capital Partners, here from Pfeffikon, it is. Then Michael Loretan from the FINMA. He's joined the FINMA in 2011, before he held an executive position at UBS in risk and compliance. Then we have Luc Mattis of Credit Suisse, Managing Director and Head of Fixed Income at Credit Suisse Asset Management. And last but not least, Mikko Sirjene, I hope I have pronounced that correctly, from Man Global Partners, co-head of real assets at Man, and a member of the Man Group Executive Committee. Perhaps you can say something about what you are doing, because if I hear Man, I think hedge fund, but you're not in the hedge fund department, are you?
Oh, absolutely not. So I used to be the CEO of a boutique manager based here, here in Switzerland, London, and the US, and we recently sold the business to Man Group to form the Global Private Markets Division. So, in a very sort of short summary, what we do is that we have two main strategies. We lend money backed by real estate. So what this means is that in Europe and the US, you may have an office building that is worth 100. We provide typically 50 of financing against that on a senior secured basis. Very, very low risk and low return. And all of our capital that comes from pension funds and insurance companies, it's unlevered.
Unleveraged,
so
no
if you think
leverage.
about a bank, a normal bank would be 20 to 30 times levered, i.e. the assets versus shareholders' equity is 20 times, and then they make these same kind of loans. We make similar loans with zero leverage. Now, the reason why our clients invest with us is that we have a lot of clients from the euro area, for example, on pension fund side, and they are getting zero yield on traditional high-grade investment-grade bonds and sovereign debt, and we're offering them a slightly better return with a very, very low risk profile. The other side of our business is a residential real estate strategy in the US, where following the financial crisis, the US housing market collapsed in value, and we've been buying thousands and thousands of residential assets across 14 different cities, which we again own unlevered, no financing, and we provide our European pension plans an income return from these residential assets.
Okay, so we had your explanation what you're exactly doing. So, Professor Franzoni, is it a good idea when we give the pension funds more freedom, more liberty to invest also in private markets? Is this a good idea?
So, as usual, from an economist, you will never get a straight answer.
Okay.
So there are pros and cons, of course, and as the speaker said, private equity provides good return, especially in recent times. The returns on private equity were very good. On average, they pay a premium of 3% per annum relative to public equity, but this premium comes from exposure to liquidity risk. And that means that private equity tends to underperform during crisis, so when the markets are very liquid, and because these investments are illiquid investments, they take a long time to recover. So it was made, the speaker made the example of the Yale endowment funds, which is a case study of investment in private equity. They had a 30% loading. Well, they lost 20% of their value during the crisis. And they have recovered now, but it took several years. So
there are some risks.
There are risks, and there is also another consideration, last important consideration, which is the competencies to choose the right projects, Yeah. So these investments require due diligence, and I don't think that such competencies are present in the majority of small and medium pension funds. And of course, the answer you will get is that they have to outsource this process, but that is costly, and the returns would therefore be eroded by this.
So part of the return go into the in this process of choosing the right thing in the right company. But you, from LGT, I think you would be quite happy if this more freedom would take place for the pension funds, because you say you have the advice.
Absolutely, we have the advice. We would be happy. On the other hand, actually, you also have to source it. So it's limited opportunity, and you also have to find the opportunity set in the market. But we have as well, we have 20 years experience running an endowment which we run for the family of Liechtenstein, and within this 20 years experience endowment fund, we also hold up 25% private equity, overall over this 20 years, 50% in alternatives. And yes, we went through 2 crises actually. And I must say it was, you need to know what you do, but the volatility has been actually lower than in equity. So that you just by asset class define the risk level and even set the limits. We are not convinced. The way we look at portfolio is from a risk premium approach. What is the exposure you want to have? So we look at if you want to get returns nowadays, given I think the chart before was a good one, or the example with the government bond was a good one, you're forced to take risk. So if you want to take equity risk, for example, so what's the best way to do it? You want to be only like in 50% equity, listed equity, or you want to do part maybe on long short with an asymmetric, different percent, or you want to do partially maybe private equity to source it, different dynamics, different volatility, different majority. And at the end, probably the answer is most likely it's a combination. And I'm not sure if by regulation, which you set up, and then I know you have to execute for the next decades, that's the best way to manage it. As we would not manage the portfolio this way.
Okay. We will go to the regulator, but just give Credit Suisse now a possibility to have their opinion. Then we ask the regulator what he thinks about this project.
Okay, I mean, in general, why we have discussion, because, okay, we can lower the benefits of a pension fund, we can increase the contributions, and the last stone we can change is actually increasing the net return, so the return after fees for a portfolio. And in general, I think just broadening the universe of opportunities in general gives you much broader opportunity set to perform in the future. And give you 2 examples. So one way, with a broader universe, what you can have is you can have, for example, take an investment with the same risk, but with a higher return. So at least you have the choice to choose in which asset class you want to invest. You can either invest into an asset class with higher risk and higher return. So if you would move, for example, from public bond to a private debt investment, of course, you're increasing your risk. You're taking probably also some other risk, like liquidity risk. But at least you have the choice to achieve your return risk targets in your portfolio. And the most important point, I think, if you're broadening the universe, is to concentrate really to take on also different risks. Because what we have seen over the last couple of years, due to the low interest rate risk, people have taken more and more of the same risk. So people have moved into longer duration, they've moved into higher credit risk, into high yield, into COCOs, into equities. So all was driven by carry trade. And just by nature, all these trades have a very high correlation. So probably it doesn't make sense to diversify your strategies and not only like optimizing your yield in the portfolio. And with this, you can actually lower your risk. So in summary, broadening your universe gives you a much more broader set to diversify your risks.
So then let's ask FINMA what you are thinking, Mr. Loretan, to this initiative. Should we give the pension funds more freedom, more possibility where they can make their investments?
With the risk of being totally boring, I would say FINMA is totally indifferent about that.
Okay.
For the first, because the OOB2, as I learned, BFAV outside, is not in the remit of FINMA. It's actually us being responsible for supervising this.
Yeah, but you have to supervise this.
No? It's a complicated thing. Swiss pension plans, it's the OAK actually who does that. But still, generally, I would say.
But this is in your reach somehow, no?
It is not. But
no.
As authority in general, and I would dare to say that also for my fellow colleagues there, the limits as such are probably good ones. One can argue about the exact level. One can discuss whether this is too high or too low. Firstly, I would say that these limits, in the example of Mr. Deplatz's, are not kind of the minimum limits. So you're probably not forced to put 100% in this totally hilarious bond, but this is the maximum. So, and if you look at it this way, I would say already now you have quite some flexibility, and maybe Mr. Franzoni, you could kind of talk more about that. Very few of the pension plans actually use up the current limits. So on average, they're far below. And of course, one can try to go with times to learn more about it, adapt them, and so on. But I don't believe that the current limits are the limiting factor in this discussion at this point in time.
Okay, so you would say it's a good regime at the moment, we don't touch it.
I dare not to say that because it's not my
your job.
actually,
Yeah.
but I would say in general limits are not bad, and limits are there not only for a certain times, but usually for some times and markets that might change.
Let's ask the opinion of Mr. Siriene and then go to Mr. Franzoni, who comes from the academic point of view. What do you think about it? He says, don't touch this regime, it's quite good, and the pension funds don't even use the possibilities they have now. So.
Sure. I guess looking at this from the sort of outside from private markets perspective, the private markets is not an asset class. So it would be the same to say that public markets is an asset class. So I would challenge that even in private credit, there are infinite number of different types of risk-return profiles. And we are at the one end of that, which is very conservative, and there are lots of people who are then chasing high returns. So again, it's hard to... What we see in other countries is that when pension funds have target allocations and private markets becomes a very small part of the portfolio, inherently the return targets become very high. And what that means is that everybody's then chasing risk and they're saying, I need to get 15% return because this is my alternative allocation. Some of our clients in Europe, for example, are saying, hey, I can't live in this zero yield environment. I'm selling some of my investment grade credit, but I need to get very, very safe return. And they're lending, for example, on a very, very conservative basis. And they're viewing that internally as an investment grade quality investment, but it's not it doesn't form part of the alternative allocation. So the problem with private markets is that you can't really say that it's not a one risk return profile, basically.
So what should the legislator do? Should we restrict, should we give more freedom, or should we stay where we are from an academic point of view?
I tend to agree with Mr. Loretana. There doesn't seem to be a demand at this point because the current level of investment in alternative products is below the limit. So the limit is 15%, if I recall correctly, and it was in your presentation. On average, the investment should be around 7%. There's obviously wide variety depending on the type of pension plan. So at this stage, there is no demand for that. You ask for the academic opinion.
But we have seen the performance, and the performance of the Swiss pension funds is not so wonderful as perhaps in other countries. Perhaps we are not so good in investing the money. It should do something.
It's certainly food for thought because something has to be done. Yeah. So the current system is not producing enough to pay for the promised benefits. So something has got to be done. I think that the role of the academic here is to point out what the potential risks are. And as I said earlier, one risk is that the recovery period is very long, and the proponents of the initiative here suggest to lengthen the period over which, the mandatory period over which the pension plans have to recover their shortfall from currently 4 to 7 years. They propose to double that period, and that means making the system less stable to some extent, because it means accepting more instability in the system. And the other issue is the liquidity. An allocation to private equity or other illiquid asset classes has to take into account the liquidity needs, the cash flows that pension plans have to pay periodically. And so the two elements have to be carefully thought.
So I see the opinions are quite split. I ask you, Mr. Fritsche, what do you think about that?
Yeah, I'm not sure if I agree, must say. First of all, I think we need a forward-looking regulation, and as we know, it takes a long time to change anything. So indeed, maybe the pension funds today are not using the limits. Nevertheless, we should have that discussion, and we should think about how the picture should look like in 5 to 10 years from now, because it is a serious problem, and the problem will not disappear. I mean, the fact, I think you showed it properly in the statement, it will just increase and not decrease. So second, then it has consequences. If you look at your pension funds in Switzerland, what we experienced, the 15% allocation, what you tend to do is you have to chase higher returns within that segment because that's the only one where you can put alternatives in. So you're even forced to take higher risk alternatives. And within alternatives, as I said before, you find all type of investments. You can structure it. What you have, in most cases, I fully agree, is illiquidity risk. So you need to look at what's the illiquidity risk somehow afforded. Maybe there, for sure, it needs a limit. But then on the other hand, pension funds are real. That's the long-term investor. So it can afford illiquidity. And as such, then, you should ideally, without the 15%, you will come probably up with a different allocation and different decisions you would take compared to what I see. Today, what we hear is in many asset classes, insurance-linked securities is another one where they say, like, look, fine, I understand it, lower return, lower tail risk, actually, that would be an ideal instrument, but I need higher return, I need at least double-digit, otherwise I cannot afford to put it into that alternative bucket. And so it has consequences. This regulation has consequences, and I think there will be a big shift moving forward, and as such, I think the discussion is important. And as said, alternative, I believe the word will disappear.
Yes.
I believe in 5 to 10 years we will not talk about that anymore.
And we will talk about then about what? What new
Investment
notion?
strategies.
Investment strategies. And what kind of private markets are there? I mean, we have talked about private markets, but let's talk a bit concretely. What kind of private markets are there? This is infrastructure, this is private debt. What is that?
Also, it's infrastructure, real estate, depending how you look at it, private debt. You give credits, the same as you do on bond side, but in a more as a more private market. Private equity for sure, commodity as a special one, and insurance-linked securities. You have both. You have the cat bonds, but the bigger market is what is called collateralized reinsurance.
Yes. And hedge funds are not in this.
Hedge funds are all, in general, it's also hedge fund is a word which is you can use very broadly.
Different strategies,
I think we have seen a lot of illiquid investment be done by hedge funds pre-08. I think today mostly it's tradable instruments. So primarily it's public, also public markets they trade in, so not the private.
So it's not hedge funds, much more private equity and the other kinds. Do you agree, Ms. Sidiani?
Absolutely, and I think private markets, let's think about it the other way around. What are public markets? You have companies, you can invest in equities or bonds issued by companies. You have real estate, again, you can invest in REITs, publicly listed real estate trusts, or buy their debt. So again, in private markets, it's the same thing. It's just a private format of the same investment. You can buy the company privately or own the stock in a public company. So, and this is the key point here, is that in private debt, for example, you can invest in investment-grade quality debt, or if you want to have a high-risk mezzanine debt, you can do that as well. So everything you can express in a public market format, you can structure this in private markets. So again, that's why I keep saying that private markets is not an asset class, it's not an allocation. Like public markets, it's not an asset class and allocation. It covers so many different risk rewards.
Matthias, do you agree?
Yes, I mean, what's the most important point, irrespective now of if you have the right weight in the regulation, as we have heard, I mean, it's not fully deployed yet, so we have still room to invest into alternative assets, but what is important is the mindset of pension funds. Because now the asset allocation is kind of like the regulatory framework, and what I like most about the capital market initiative is that you put together a different framework. So, for example, you have the fixed income space, but then you add, for example, private debt into this. So the pension fund can allocate how much they would like to put into more liquid fixed income, how much they would put into illiquid fixed income. Perhaps they would put something in a long-short fixed income strategy into the fixed income bucket. So mentally, there has to be in a different asset allocation than the BVV2 investment guidelines. And I think that's important. Of course, if you would change something in the regulatory framework, we could actually speed up the process. But for the time being, actually, there is enough room still to act for a pension fund on this basis.
Okay, Mr. Loretan, are you convinced?
Well, as I said at the outset, I'm still totally indifferent because, and rightly, authorities should be, because at the end of the day, whether this is FINMA or any other body who is supposed to implement, supervise this, if they opine strongly on these things publicly beforehand, that's probably not good for their reputation. Doesn't make that much sense.
Okay, but
on the other hand,
perhaps the politician needs some advice sometimes.
Yeah, well, if they come, they can ask for, and I probably have some kind of idea what I would, as a insured person in these pension plans, would feel like, and I would.
And
then,
what do you feel as an
then I would agree with the gentleman around me that I say, of course, the illiquidity premium that one of the most longest term investor that exists could actually get, why shouldn't they do that? And if they do this within the regulatory and legal framework, then it's all the better. If they don't, then probably some authority would ask them to go back to that framework. And if the framework is being changed, then of course the whole process is adapted accordingly.
Okay, but you privately wouldn't say the framework should be changed?
Privately, I say probably
I haven't
not
really
different to
heard your answer.
If the framework is not being used, it doesn't seem to be the restricting factor at this point in time. And one can always find better solutions, and maybe that solution is better. The legislative process will show it.
Okay, we see what happens because this is in the legislative process, in the FIDLEG, I think, or where is it in this process?
This is a different initiative. This is not being in that specific area yet.
Okay.
But this will come into the public domain and discussion soon, I guess.
Okay, so let's talk a little bit about other trends in the asset management industry. And one trend is the trend going to passive investments. Mr. Franzoni, is this a good trend, or are there some dangers in it?
You ask me always for judgment.
Yes, of course. The professors always have to have
As
judgment.
a scientist, I'm...
Disclaimer.
I'm reluctant to give you.
The bankers can have disclaimers, but the professors no.
So let me just give you the picture. So, and I talk a little bit about the United States, which is at the forefront of any trend in finance. In the 80s, 0% of the assets under management were managed passively. And nowadays, it's about a third of the assets that are managed passively. There are forecasts, for example, Moody's recently made a research suggesting that in the next 4 to 7 years, the amount of assets that are managed passively will overtake the actively managed assets. So is this good? Is this bad? Well, let me just say, a few thoughts. First one is, we need active management. So financial markets and the world at large need active management because it is informed active managers that bring information into prices. And so it's not the passive managers who just follow an index that make prices efficient. And we need efficient prices in the economy because that's how our resources are allocated to the good investment projects. So active management is necessary in the economy.
So you say, when we don't have enough active management, then we don't have really efficient markets anymore.
That is
the danger.
That's a claim, yes, that's dangerous. That's the first thought. The second thought is, well, there is more and more academic research showing that even passive investors create distortion in financial markets. So we can talk more about that later, but just as an example, passive managers hug the index, they track an index, and so they create discrimination between the securities that are within the index and securities that are outside the index. So the security in the index, when there are flows into the passive investors, they increase in value, so they are overvalued, whereas the securities that are outside the index tend to be undervalued. And so this is just one of the many distortions that are created by any growth in passive investments. And we need active investors to correct these distortions. So it's a symbiotic relation.
Yes, we need both of it. And but when does it really get dangerous? When it's 50% or 60% passive investment?
And again, this is a very tough question. So people, some researchers have tried to answer this question. So how much active investment will eventually survive? Some are actually very pessimistic. The president of the American Finance Association in 2014 made a forecast that by 2042, there would be zero revenues to active managers.
Okay.
I think that's a very pessimistic forecast because, as I said, there will always be space for active management given that passive investors by themselves create distortions to be corrected.
So it's important to have the active investors. But would you agree that there is a trend to the passive investments and that this trend will even accelerate?
For sure. What we see, we are in a low return environment, so all investors, including the institutional investors. So you have to somehow seek cost-efficient solutions. So you look at what is the value added generated by the investments you do, and as such, if you look at active investment, you see it over a long time frame. Actually, it hasn't outperformed given the cost, and as such, there is for sure a big trend towards passive. Now, the point will be in how do you then put that together? The passive instrument is it's an instrument. It's not the solution to the whole world. And as such, you might find active strategies which are extremely useful. But what we have seen, maybe that has been a great run for the asset management industry on the long-only side for a decade or two, that you just, if you have like a small tracking error and you just manage along a benchmark, that you get paid 1% for this, maybe that's not the case anymore, and the industry has to adapt to that trend too.
So you would say active management is always demanded, or could there be a situation where, like he said it, zero?
Active management for sure is always an opportunity, because if everybody goes that direction, it creates opportunities
for the other one.
Exactly.
That would be this effect. Mr. Loreton, how do you look at this development?
Well, with the risk, again, of being boring,
a regulator has to be boring.
We have both. So, and actually, the regulator is not the one that's supposed to be innovative and influence and change markets and so on. They rightly are boring. I think by nature they're supposed to be.
But if everything is passive, you haven't.
The risk of getting there or being there is relatively low or distant, at least. And if we look at the different markets, how developed they are, we are certainly lagging behind the American US market. So we could learn. If the whole thing tips in the US, we probably could learn what to do here. But we get both. We get requests for authorization for active funds, which we happily kind of look into, and if everything is okay, we grant that. And we do the same for passive ones. So
also you're completely indifferent.
Well, the law provides that you can do both, so we should look at both. Maybe at a given point in time, if the whole thing is at a tipping point, and there are some standard setter international discussions when this could actually happen. So there could be eventually some international standards giving guidance on that, which again would then have to be deployed on national law and come into force like years later. This could come eventually, but this is...
But we are still not there at this tipping point. It's far away. Let's ask Mr. Mathis. We are not at this tipping point. You are agreeing?
Well, Professor Fancioni said that I have still a job in 2040 with a low salary, but then I'm just retired, so I'm fine.
Okay.
Just shouldn't change the retirement age in Switzerland. No, I mean, indexing is a big trend. We also see it at our Credit Suisse, how we grow on the indexing.
It's a big trend, but the big Swiss banks have a little bit were not very active in this field. Are they?
No, we are, of course. We are active. A couple of banks are active in the index space, but I think it's a big trend, and we still have some potential, for example, in Europe, because in the US, I think 1/3 of investment funds are already kind of passively managed. So in Europe and in other regions, the ratio is still lower. But we'll also have other influence factors. So regulation, I think, from a cost transparency perspective, probably also favoring a little bit more passive investment in the future. But what happens if interest rates go up? What happens if we want to see a market correction with this portion of index funds, we don't know yet. So there could be a lot of different influence factors changing a little bit the growth factor of passive investing. The very positive side effect of the growth of passive investing is actually that the active investing part has to become stronger. So if an active manager has just been an expensive passive manager in the past, so he has no, he will not survive in the future. So you will really see a separation. So either you're a strong performer or you're out of the business. And this is actually very good for investors because they can choose between strongly skilled active manager and passive manager.
And there is maybe some role that the authority can play there. In order to have that information out in the market, transparency is extremely important. And so this is part of our job to make sure that transparency is given to investors what they actually pay for example.
And whatever investment, transparency everywhere, active or passive.
Absolutely.
I guess at Man Group, outside my area of responsibility, we have about $40 billion in different types of systematic strategies, and a big chunk of that is in equities today, run out of Boston or London. And I think what we're seeing a significant growth in this area where asset owners are allocating out of the traditional long-only equity structures where an individual is making the stock picking calls and as pointed out by the research here, don't traditionally add value, and we're seeing a lot of assets flowing into the systematic side, and where our performance has been very strong in the last few years.
In this new world where passive investments are so important, is there then a new role for active investment, and on what should active investment really concentrate?
Okay, I think there are interesting results from the academic literature that suggest that there are new distortions created by passive investors. So let me give you just a few examples. For example, in the commodity space, volatility and correlation of future prices, even for totally unrelated commodity, agricultural commodity, raw materials, oil, have increased as these commodities have become part of indexes. Just because there are flows and inflows out of these passive instruments, this creates correlation among products that were previously unrelated. And by the way, these has real implications because not only the future prices are more volatile, but also the prices of the commodity themselves and the inventories of these commodities. So there are implications in the real economy. ETFs, which is a topic that I've been researching, ETFs create volatility. They create volatility for the securities in their baskets. They create correlation in the securities of their baskets. And as I said earlier, the securities that are inside ETFs tend to be overpriced relative to the securities that are outside ETFs. So there is space for new trading strategies based on volatility trading, long-short strategies, as was said. So all quantitative strategies that active managers, smart active managers can play to correct these distortions.
So there will be some work left to active investors and active managers. Do you agree?
No,
even more space now with this more passive investment, so we have much more liberties out there for active investors.
What I believe is that managing something very narrow to the benchmark or to the index, that might disappear.
That is out.
Exactly. So somehow you're forced to search for that alpha, meaning you have to look at different signals, you have to look at more at the fundamentals, you have to create something, add something to the basic strategies, and the ETF's passive part become the efficient beta delivery. But there's for sure room for add-on strategies.
Okay, I take the opportunity to ask Mr. Loretan a question which we had before about fintech. How should we regulate fintech? Because here you're really in charge. Some people have said, or there was a question, should we regulate fintechs less than the big banks? What is your opinion there?
Well, I have an opinion there. And actually, it's even not FINMA in charge, it's out in the legislative process. So it's the political world, the political arena is discussing this, and there are as many times two sides to the medal. So if you say you would like to have lighter regulation legislation to fintechs, would this then mean on the other side that you have stronger legislation for all the others? So do you really want to create some inequality there, or shouldn't there be an equal playing field? I'm rather for the second, and that's actually why FINMA we on our own, we kind of kicked off an initiative to make the Swiss FINMA regulation technology neutral, that's how we called it. So to take out elements which could actually disadvantage fintechs out of regulation. This is, for example, that in many instances there was some formal written statement required. All this is not necessary anymore, so we make it neutral there.
So you're taking out the disadvantages?
Yes.
But you don't want to have a separate kind of regulation for this?
I believe probably the level playing field is extremely important, and one cannot necessarily kind of play just on one side, because maybe in 5 years' time what is now fintech is then low tech, and it gets a bit messy, the whole thing. But what is out there in the legislative process is to actually create two new things. One is to create a so-called sandbox, meaning there is a specific room limited in space, meaning limited in amount of money that can be invested, limited in the actual activity that can be done with no or the only kind of laws to be observed is the anti-money laundering law. So this is one thing, this sandbox. In this sandbox, actually everybody who fulfills the requirements can enter and so-called play around, being this fintech, new style, old style, whatever. Anybody can do that. And the second thing is that there is the debate about a different license type, formally introduced in the not very fancy name of banking license light. It was kind of then changed into innovator's license or the like. So this is a new type of license which is substantially below the requirements of a banking license, which should help actually business cases that are in some way a bit bank-like, but not quite a bank.
Not quite a bank. So we see you have thought about that and you have proposed some things. Okay. Do you think this is a good idea to have such a license for fintechs and to give them a little bit more space, a bit more room, Mr. Matis?
Well, that's, I think the playing field should be a little bit the same for financial institutions and for these fintech companies, but I think it's a long process. We don't have really experience with this sector. So I think it will take some time until probably we find some final solution.
Okay, so we see there is some possibilities are there, and I think this answers the question. Now we have the possibility to answer, to have questions for the whole panel here now. Take the opportunity to ask some questions. We don't want to have the discussion only here. Be active. Here we have a question.
I have just one question, which might be answered with a combination of Mr. Martis and Mr. Lorton. You mentioned, is an active manager being just a very expensive passive manager in the past, so he has to increase active share. And I would like to follow through with the closed indexing initiative of the FINMA, the Umschreiben. Is the asset management industry, do we have to expect that the FINMA will become active or more active with closed indexing manager going forward, or where do you stand in terms of this initiative?
Who wants to answer? Mr. Loreto.
Well, happy to answer on that. So I wouldn't necessarily call this an initiative or the like, but we do kind of supervise the funds as such, and in line with the debate internationally kicked off, originally in Denmark and then coming all the way through, the notion of index closet indexing was kind of born to actually describe what you mentioned, passive but charged actively. We looked into that. We found some funds that one could probably fit into that category. What we usually then do, we approach the respective market participants. We kindly invite them to change that. They usually do that. As of now, there's no such initiative or the like ongoing. But what we do anyway in the regular process of authorizing funds, if somebody comes up with kind of a total super duper active whatever brand, and then kind of in the description of the fund says that actually I track whatever index, then we probably go back and say, well, my friend, you either change the name, you change the style, or adapt the prices, whatever, but we do not intervene like we say you need to change the prices, because as long as these things are made transparent, that's also my personal belief, as long as the investors know what they buy, they probably should decide themselves, and the ones that overcharge what they actually perform for in a transparent and functioning market, they will get kind of kicked out of the market.
So I totally agree. So as long as you are transparent and the investor knows what you do, you will be out of the market anyway, because you track the index, but you're always minus 1% behind the indexer, then you're going out of the business soon, you know. And my firm belief is, so in the future, either you're, as an active asset manager, you are really an outperformer. You provide solutions for niche markets like convertibles. You can not easily index a convertible bond market, or very inefficiently, for example. Or you provide like customized cash flow patterns, like some perhaps non-traditional patterns that cannot be easily replicated. Or you really go in the unconstrained area, so where you have a lot of flexibility, perhaps even not a benchmark, what you cannot then index in any way. Yeah? So, but in the end, it has to be investment talents that can incorporate these kind of solutions.
Okay. Other questions? We don't see it really. Here it is. Yes.
And back to the point, active funds and passive funds. In my opinion, the discussion is not about the way to manage the fund, so to track an index or to generate alpha, but I have the feeling that it's more about diversification or access to a kind of very specific market. I mean that until the 90s or 2000s, the bulk of the funds were active and very broad market. Could be multi-asset, could be a broad market of equity, of bonds. And now we are in a period where it's really tailor-made. So the trend is everywhere, like in the car industry, in the financial industry as well, in the consumer staple industry. We want to have access to very specific sectors, regions, factors maybe. And I have the feeling that the passive investment is one good way to follow this trend. What is your opinion? So meaning that in fact the discussion is not about active passive, but diversified or niche.
Who wants to answer?
Or I can just, I fully agree with you. So I think indexing is a good way to build risk factors or exposures in your portfolio. But I just think it's not the only way. I think there is space for active. So I wouldn't agree that you can rebuild everything with passive. Because as I've mentioned, we haven't seen yet, for example, strong market correction with this stake of passive investing in the market. So there is even evidence, for example, that being a member in an index is changing your valuation. So meaning like there's some studies that a stock being in an index is 60% higher valued than the stock that is not in the index. So there might be some size influence or bias as well. But just the fact that you're an index makes you more expensive. So you see there is also coming some distortions, and this gives also room to a more active manager, or perhaps a manager that can have a higher cash quota in a market correction, or we don't know yet, for example, if the market corrects, if everybody wants to leave the door in a market correction. So we haven't experienced really all the kind of scenarios yet. But I agree, indexing is a comfortable way and efficient way to build risk factors into your portfolio.
Yeah.
Mr. Franzoni?
So I agree with the question, also with the answer. If I can add, this way of constructing portfolios is a way of providing betas on different factors, but there's still space for providing alphas. And for a large majority of active managers, they should strive to provide alphas because providing betas has a large economies of scales and the big players have a clear advantage there. We see the BlackRock of the world that are providing betas very efficiently at low cost. So the space for the others who are not BlackRock is really to provide, not to strive to provide alphas.
Especially for the Swiss asset management industry, must be there. I know you have had a lot of research, you've done a lot of research about hedge funds. Perhaps you could also mention that, the danger of hedge funds and what do the hedge funds do to the markets. Can you tell us a little bit from your research?
Yeah, let me put it into context. So this recent research was motivated by the regulatory changes that have followed the last financial crisis, in particular in the United States, the Dodd-Frank Act and the Volcker Rule, that mandate a separation between financial institutions and hedge funds and also private equity. And so the question we have been addressing in this research is whether this is a good idea.
To separate it.
To separate financial institutions from private funds. And therefore, we look at funds that have an affiliation, hedge funds that have an affiliation with a financial conglomerate, which is a bank, an insurance, and broker-dealer, and we look at how they trade. Well, first of all, we notice that they have a more stable funding basis in crisis periods. What does it mean? It means that investors are less likely, less inclined to withdraw their capital from these funds in bad times. Why is that? Well, probably because investors believe in the reputation of the institution that is standing behind these funds, and they believe that the institution will step in at times of crisis to provide credit to the fund in case of troubles. And so they have more stable capital and they make good use of this capital. So what they do is that during crisis, they take more exposures to securities that other investors are liquidating. For example, securities with high volatility, securities that become very liquid. So in general, they take more risk when everybody else is getting out of the market. So in this sense, these affiliated funds are providing a stabilizing force for financial markets. And I should say, this regulation of separating banks from funds is being discussed in Europe, is being discussed in the UK, and luckily Switzerland is not following this regulatory trend so far.
Okay, in Switzerland this is not discussed, Mr. Loretan, this separation.
Well, the Swiss autonomy provides for us the liberty to do what we believe is right. In many instances, we do follow what is internationally being applied for good reasons, and if only to kind of keep and gain market access. But of course, we do not need to follow everything, and we can actually, on some instances, really stand back and not do that, yes.
So you would say it's not a good idea to separate these two things, because after the financial crisis, everybody has said hedge funds are bad and they should be separate from banks. That's not a good idea.
There is a reason for this regulation, which is the limit risk taking by financial institutions, which we saw was a major issue during the crisis. We are just putting forward a reason why perhaps the regulations should be restricted to some extent. And the recent debate in the United States, where the Dodd-Frank is being reconsidered by the new administration in the US. I don't want to speak in favor of the new administration, but this is what is being done there. Suggests that perhaps the regulation was too strict. And let me just cite a quote, which I think to some extent summarizes well the results of our research, or the policy implication of our research. And it's a quote in a letter to shareholders by Jamie Dimon to the shareholders of JP Morgan. He says, regulation must be flexible enough to allow banks to act as a bulwark against market panics.
Okay, good. Would you agree with this sentence?
Well, I would say, as always, two sides to the coin also there. So the kind of the banking sector absorbing all shocks would probably endanger or could endanger the banking sector as such. And in there, then we have kind of the usual prudential measures to take care of that, with capital, liquidity, and all these things. And if you would want the banking sector to absorb very large and all shocks, then you probably would need to underpin this with that much capital that you would have another problem. So but in general, one can argue this way, yes.
Okay. Is there any other question? Then we would go into the last round. No questions left. With this private market initiative, would you say private markets are in 2-3 years stronger and there are more investments there, Mr. Franzoni?
It depends. So if we look at the trends around the world, there are reasons to doubt about that. The large pension funds around the world are disinvesting from hedge funds in particular. So the example is the example of CalPERS, this huge pension fund of California public employees. It's a 300 billion pension fund. It's completely disinvested from hedge funds. If we look at infrastructure, there's an example of a fund that was promoted by the British government. They wanted to raise 20 billion to invest in infrastructure and eventually only managed to collect 1 billion. And the problem is that pension funds need, as we were saying, steady cash flows, and infrastructure has an initial period in which there's no cash flow, but the initial period can be very long. So the general trend is not favorable for private investments by pension funds especially.
Okay.
But
your opinion in 3 or 5 years, where are we with this subject? Private markets, investments?
First of all, there are many studies out which say that the market will grow significantly. Second, from our own experience, and I think we do business across the globe, we see major demand moving into private markets. And private markets as defined not with hedge funds, but private markets. And I just give you a recent example. One is Japan, where just the two largest investors in Japan, one the government and the second one is Japanese Post, did their first investment now into private equity. So out of a 1.5 trillion fund, they apply now 1%, okay, 15 billion. So what is the next thing that will happen? And we know that discussions already. Next thing will happen, 1% is useless. So they will ask for a second. This is then 30 billion investment. Now, if the largest Japanese investor is going to do that, all Japanese institutions are following. So if I look, and I can make you examples in Korea, I can make you examples in North America, there is plenty of demand coming into the market. That's for private equity, that's for private markets for sure. That's for private debt for sure. We see it in insurance linked. The only thing, the issue is sourcing. It's not demand. So there's a big shift towards that, and we are start to be more afraid about the opportunity set. And the issue now is the focus is to be very disciplined in your investment approach, because there's a lot of institutional money coming into that market. This will grow massively.
Massive growth. Mr. Loretan, you're indifferent about the growth anyway?
I forgot the crystal ball this morning, so it's I simply don't know. It's not the key knowledge of the regulator.
Of the regulator. Okay, we ask Credit Suisse.
So private markets, so private debt.
Private markets, private debt.
I think this is surely, I mean, from a supply side, surely going to increase because banks are kind of pulling out of the market, you know, because of obvious reasons. So there needs somebody to step in probably to lend, for example, you know, and this trend can also be seen. If we then, for example, touch on the hedge fund industry, what I think is that we have more like a merging of the traditional and of the hedge fund industry. So we see already, and we are active, or we see that, for example, you apply kind of hedge fund strategies, but in a fully transparent and regulated fund, for example. This is possible, and it's transparent also from a fee perspective. It's regulated, it's controlled. But the strategies you apply are actually also used in the hedge fund industry. So I think there is more like a merging of the two sectors, which is actually a good development in my view.
So you see a big potential there?
Yes.
Okay. Mr. Sigene?
Sure, I agree that there is a significant demand for yield at the moment, and a cynical side of me basically looks at this saying we are quite late in a credit cycle at the moment. Interest rates are very low. And that part of the money that is coming to these private markets, that is just basically saying, I can't get return elsewhere, therefore I need to go private markets. And those actors who are not necessarily good at differentiating what risks they're taking, I think that can lead into all kinds of trouble going forward. So investing in these markets takes a lot of expertise, basically, and I think one needs to ask what is the motivation going to these strategies, and there are good motivations and bad motivations, but somehow it feels like we are towards the end of this cycle rather than the beginning of the cycle. So our position is very conservative, therefore.
Okay, thank you very much, the whole panel. I think it was quite interesting to see that there are potentials and there is a certain growth during the next years. Thank you very much for all of you. Thank you. Mr. Franzoni, Mr. Fritschi, Mr. Loretan, Mr. Mattis, and Mr. Siriani. Thank you very much.